Happy holidays from the halls of justice. Good Saturday morning, afternoon, evening, depending upon where you are in the city. Thank you for joining us today, and it is the holiday season. My colleague and partner, Murvet Arnstein, is here with us today, and she's the other producer of our show. Say hello, Murvet.
Hello, good morning, happy holidays.
And we have a very special guest with us today. We're going to do a little something different on From the Halls of Justice. We've got Teresa Todd, who is with Rodeo Realty, and she is going to tell us about real estate. And it is a real opportunity to have her with us, and she is an expert. And so we're going to lead off. And this is our first real estate show from the Halls of Justice. So once again, Teresa Todd, tell us a little bit about how you got into real estate.
Well, I was originally going to be a teacher my whole life. And in the 1970s, society changed, schools changed. I decided to go into banking, work at a utility company, had family. And then I thought, okay, now what am I going to do? I stayed home with the kids for a few years, had to have a job that would give me flexibility. A friend of mine, her mother was a broker and owner of her own company, and I thought, great opportunity. And that was in 1985.
Wow.
So I've been selling real estate ever since.
Wow, that's wonderful. Now, you're a sales manager, right?
That's correct. I've been managing for Rodeo now for 13 years. Wow. I have about 140 or 150 agents that work with me. Yes, and it gives me opportunity to do that teaching that I used to think I could do. Do office meetings and all sorts of things, plus on occasion sell to my own past clients, friends, and family. So.
Awesome. Now, during the tough economy, how have home sales been?
It's been challenging over the last few years, but I'll actually say the last 2 years has started to be stabilized for us. Mm-hmm. We started 2011 pretty strong. Mm-hmm. A lot of buyers out there. The hard part is not enough sellers. So we don't have enough inventory to accommodate all the buyers.
Really?
Yes. It's a great opportunity for real estate right now. The numbers tapered off a little bit just this last couple months. Again, not enough listings.
Well, probably a lot of people are holding off. They don't want to sell because the price is low.
But that's where the opportunity is.
Yeah. Well, for the buyers, of course.
Yes.
So,
and for people who might want to move up.
Yeah, I'd love to move up. People say that it's hard to get a loan right now. I think that's like the 99% chant that I hear. What do you have to say about that?
What's really ironic is that it's easier to get a loan today than it was in 1985. Absolutely true, and for a couple of reasons. Number one, what we call the loan to value ratios. We used to have to put 20% down, 10% down with PMI. Now you can go in with as little as 3.5% down and buy a house. Also, your income ratios. You couldn't have more than a 36 to 38% back-end ratio, which is your total in debt, monthly payment, including housing, compared to your monthly income. Mm-hmm. Today, you could actually get a loan with reasonable credit with as much as a 54% back-end ratio. That means half your income could go to paying housing and debt. That, when you think in those terms, it's easier to get a loan today than it was then.
That's amazing, because that is the big issue that I hear, is that it's hard to get a loan. So is it a good time to, like you said, well, we figured out buy or sell real estate. So
yes. Buying is the phenomenal opportunity right now. You can buy a house, like I say, with very little down. It's interest rates are low, prices are down, so it's much more affordable. But for a homeowner that's been in his house for, say, 10 years or more, mm-hmm. it is an optimum time to make that move up, to sell that house and move to something bigger, mm-hmm. better neighborhood. The hard part is that it was very different at the peak of the market, mm-hmm. because there were no qualifying guidelines for loans. Anybody that had a pulse could buy something. So comparing 2008 2006, 2007, all those years, immediately prior to this crunch in the market and the economy, it seems more difficult, but all in all, in history, it is a great time to buy and sell.
Wow.
So what makes this a good season for real estate sales?
This has been what you would consider a historic event. It rarely happens. Prices dropped as much as 30% from where they were at the peak.
Wow.
And at the very same time, we have historically low interest rates. My parents, when they bought their house in the 50s, their loans were at 4.5% and 5%.
Right.
We're at 4% and have been consistently at 4% this year, most of 2011. So when you put those two factors together, you have a lot more buying power, you have more opportunity, and the number of people who qualify increase because they have jobs, they have income, and what their money will buy is much more affordable.
Wow.
So what should a first-time buyer do to take the best advantage of this market?
So many people go online nowadays. They love the internet, and the internet is an incredible source for information. However, they make a mistake of going to some self-analysis or qualification system. They go online, or they'll read the paper, or they'll even talk to their local branch, a bank or whatever, and they will find out what it is to get pre-approved or pre-qualified. Okay? The thing is, that's the first step any buyer should do, but they shouldn't do it themselves. They really need to make sure that the professional that they're talking to knows how to pre-approve them as opposed to pre-qualify them.
So what's the difference between the pre-approved and pre-qualified?
Good question. I was thinking that.
Pre-qualification is really kind of a misnomer. We always make a joke that it's only worth whatever the piece of paper is that it's written on.
Okay.
Bottom line, I call you, I say, I make this amount of money per month. How much can I afford? So there's absolutely no documentation or verification that goes into it. They might even run your credit report, but that's not what's crucial. What's absolutely important is 2 years tax returns, 2 months bank statements. You have to have your pay stubs, because there are a lot of factors that go into determining how much your qualifying income is.
Okay.
And that's what the difference is. Pre-qualification means you've done a loan application and they've seen all of that.
So do they just walk into a bank or go to the internet to get pre-approved?
The best thing is to go to someone that you've been referred to through a real estate agent, because real estate agents have the experience as to who knows how to do their job.
Okay.
Our job depends on closing escrows, and we only get them closed if buyers qualify.
Exactly.
Most people think, I can walk into my local bank and they'll get me approved. Yes and no. The problem is they often will sit with a person who will take an application and they don't see tax returns. So they have no idea what your qualifying income really is. They'll run a credit report and you'll go through the whole process, and at the very end the underwriter will say, now I want to see your tax returns, now I want to see your bank statements. And if you've done something that questionable in the way you've processed things, meaning a big deposit of cash all of a sudden in your bank account, can totally blow out using that money on your for down payment and credit report financing. So the best thing is to go to like a mortgage broker who's experienced and who understands the process, and they actually do that process and get you underwritten right away.
So should they do more than just tell the lender how much they make and run their credit report?
Absolutely. That things that affect your income are, do you pay alimony or child support? Do you write off expenses from your business? There's so many factors to consider that just because you think I make $5,000 a month doesn't mean that's what the bank's going to use as your income. And so that's why the tax returns are crucial, to see what your bottom line is on that tax return.
I see. How do they know what kind of loan they should get?
a good mortgage advisor will sit with them and ask them what's their future plans. You know, how long do you plan on being in this house? Do you want to stay there for 20 years, or do you plan on making a move in 5 or 6 years? And they'll sit down and analyze what is the best type of financing for them. Maybe they shouldn't use all their cash. Maybe they should just use 3.5% or 5% down and get a certain loan that will actually have the same benefits to them. So it really depends on what your future plans are.
What's the minimum down payment for a purchase of a house?
You can buy a house with FHA financing with as little as 3.5% down. And all of that money can be a gift from a blood relative, your parents or your grandparents, you know, or cousins. Also, you could have a co-borrower who is a relative who's not even going to live on the property.
And that's allowed.
And that's allowed with FHA.
Now let me ask you something. What is better? Because I see, in your opinion, I see a lot of HUD properties coming along now. So HUD properties, do they have to be FHA approved, or is it a good buy, and do you go through the same process for being qualified?
It's a little different. A HUD property generally is an FHA loan that's now bank owned. They foreclosed.
Okay.
And HUD now, because they insure the loan, owns that property.
Okay.
So they do things online bids, but you go through a realtor just like normal. You would actually, they are FHA approved generally because they already are insured by HUD.
Okay.
And so if you go to a realtor, they can help you get approved. There are certain time periods where investors have to hold off and wait. They can't submit an offer until so many days. And so the benefit is to try and get a buyer in that would be a first-time buyer to take that property.
So should they start looking at short sales, bank-owned or regular-owned properties?
A big part of that decision is how soon do you want to be in a house? If you have a time frame, I want to be in a house before summer, I want to be in a house in 60 or 90 days, then a short sale absolutely is not your best opportunity, because the process is dependent on the seller and their bank, not the buyer and how well qualified they are. So for a buyer who wants to get into a home within a certain time frame, definitely a bank-owned property or a standard sale or regular sale is their best opportunity to get into something in a certain time frame.
I'm sorry, what's a short sale actually?
That's when a property is what we call upside down, where the financing, the loans against that property are higher than what that seller would net when they go to sell it.
I see.
So in order to sell that property, they actually have to get their lender's approval to say, I'm willing to take less money on this house against this loan. And otherwise the seller would have to bring money from his own pocket to make the difference.
And I understand the other problem with the short sale is it's normally the second that gives you the biggest problem, because even if you get the first to agree, then you have to go through the second because they get the short end of the stick.
That's right. And sometimes these properties have homeowner associations, and they haven't been making payments on those, and the HOAs don't want to accept less. So you've got to get approval for each of the loans that are on it. And then if you have an IRS lien on it, IRS will work with you on a short sale. Takes about 30 days, but see how every step takes at least 30, 60, or 90 days to go through. Some people, it has taken as much as a year or a year and a half to get the short sales approved.
So if you're not in a hurry, the only thing is, like when you get a loan approved though, that loan is only good for 90 days, right? That
Usually
amount, or that
45 or 60 days usually is what you lock in. You can't get a loan locked in. You can't even get your financing approved because you don't know the final price that property is going to sell for. Because just because you write an offer and the seller signs it and says, yes, I'll sell it to you for this so long as my bank approves it, you have to wait for that whole process to go through, and then you get your appraisal. Now, if that bank said, well, I like your offer, but it doesn't get me the right bottom line, they come back with asking for more, or saying, I won't pay for these fees, somebody else has to.
Wow.
So now this buyer's waited all this time, they hear the market is really bad, the economy's bad, so why am I paying more for this house? I want to pay less. And so it does complicate the matters. And generally speaking, most what you would consider a regular buyer gets very frustrated by the process and ends up walking away. And so for the listing agent, the good news is they had an offer to start the ball rolling with the bank to find out what the bank's willing to do. And then they end up putting it back on the market.
Yeah, you see a lot of that. Okay. Did we ask, besides first-time buyers, I know this part because this kills me. Would you say that this is a good time for investors to buy? And me, I just got to tell you something. Me personally, I just get so frustrated when you see a really good lowball price on a property for someone like myself who you'd love to buy it. And you go in and you hear that it's gone. And it's gone because, I'm an all-American. I want that dream piece of pie. I can qualify for this loan of, $150,000 or $200,000 or whatever, and this property is only $80,000 or $155,000. And oh my God, I'm finally going to get that condo I always wanted. And somebody comes along with, I don't know, $80,000, $90,000 cash, and they buy it. So, yeah, is this a good time for investors? No.
Well, with the stock market being as volatile as it's been for one day to the next, who knows how much money you have, a number of people have decided, you know what, it's time to put my money in a house. Because, again, for the first time in a long time, a buyer can go in with 20% down, and based on the rents in the area, can have a positive cash flow. Used to have negatives, used to have depreciation was the only way you made money for the first few years. But today, it is so good that yes, you can actually walk in, buy a home, even with a mortgage on it, and have a positive cash flow. It's a great time to be an investor. Most of us just don't have enough money to do that.
Right.
We didn't plan ahead right.
Wow. Let's see. What do you need to know before going out and buying rentals? I had never thought of that.
Yes. Well, see, it's actually better market for rentals for a landlord to go in and buy and keep the house and rent them than it would be for someone who goes in, buys a house, fixes it up, and flips. Because there's not enough room to make a lot of money in some of those. So unless you happen to be a professional who knows how to go in and have crews to fix things, it's very risky for the average person to go in and start doing that. But for the average person to start buying rentals, again, because rents right now are high, you know why? All these people that have been in foreclosure, all these people who are in short sale situations, they have to live somewhere. So we have a high demand for rentals. That's why the rental prices are high.
Well, okay, interesting enough. You said it's a good time to move up. So how does that work? I mean, between the finances and the money, and I'm still flabbergasted that you say it's a good time. It's a better time to get a loan, because I thought if it's a paper trail and people are saying banks aren't giving any money.
That's what we hear all the time.
Yeah.
Banks don't make money unless they loan money out. So it's just, and right now money is almost free at 4% and sometimes below that. So, but for someone right now to make that move up, at the peak of the market, let's say their house was worth $500,000. They would have wanted to sell that and buy something around $900,000. Well, the cost difference, if they had 20% to put down, the interest rates were 6.5% approximately. So their payment on the new house would have been $4,500. Today, their house might only be worth $350,000. And the house they're going to buy is worth about $650,000. They put their 20% down. The interest rates are 4%. The payment is only $2,500. That's over $2,000 savings just in payment alone.
Wow.
they're saving approximately $400,000 in the purchase price, even though they went from a lower price on their end to what they're buying.
You're pretty smart. Let's see. Let's see. So what makes this a better time to do now than in 2005? Because your head is really good with numbers. I'm impressed.
Well, during that time, as I said, the payments would have been higher and the prices would have been higher. But what you've got now is more stable prices. Okay? Back then, every time you turned around, the prices were going up. You know. But the incomes weren't going up as fast as the prices were. That's why everybody used those no qualifying, actually no verifying of their qualification type loans, and they got in trouble. The prices were going up, the values were going up faster than anybody could afford those payments. And then when it stopped, everybody hit the skids. But today, if you've had a good job and you have some stability, you want lower payments.
Right.
And so you could actually take the keys from one house, where you are now, maybe your interest rate is 7 or 8%, or even as low as 6.5%, and you could buy a bigger, better house and have the same or less payment than what you're paying on your own house right now. Why wouldn't that be a good thing to do?
Okay. Right. So do lower prices have much of an effect on property taxes?
Absolutely. That same $900,000 house, when you would have bought it back at the peak, your property taxes would have been over $11,000 a year. That means you're almost paying an extra $1,000 a month. Towards so we were at $4,500. Now we're at $5,500.
Right.
Okay. Now at $650,000, your property taxes are going to be like $7,500.
Okay.
In a year. So you're saving about $300 a month in property taxes. So altogether, you probably saved $2,500 a month by buying that same house today.
Wow.
What a bargain.
Yeah, that's okay. Now, what happens if they can't sell their home? Can they still move up?
In certain situations, absolutely yes. If you have 30% equity in your property, that means your loan to value can't exceed 70%. Then the lenders will let you use rental income to offset that mortgage. And you can actually, with an FHA loan, 3.5% down, buy a new home.
What's rental? Oh, rental income from another property?
From that same house.
Oh, okay.
Because one of the conditions will be you have to have a lease signed. You can't say, I'm going to lease it. Before they fund your new loan on the purchase, they want to see a copy of a lease executed with a tenant and some form of money exchanged, whether it's a security deposit or some rent, advanced rent, put in your bank account. They need paper trails for everything.
Right.
And so with that in mind, you could actually keep your house rented out and go and buy another house.
Right.
And have that new home for less mortgage payment than or the same payment as what you're making on your current home.
That's awesome. Murvet, you and Arnie need to buy another little house. And I'll be your lease and renter.
Okay, that's a good idea.
Oh my God, you are smart. No.
Now you know why I've been managing for so long.
Wow. Well, we have about 3 minutes left. So, are there any heartburning questions that you want to ask in our 3 minutes?
Oh, usually it's about renting. You know, if you say you own a home, it's paid up totally, and you move somewhere else and renting it. Say you want to rent your other house. What are the tax problems you might run into?
Well, you definitely want to talk to your accountant to see how that plays out. But it's very easy to convert your existing home into a rental property. You'll have income, so it's going to be positive income for you.
Yeah.
You may actually end up wanting to pull some equity out of that house and using that money to help you leverage something else.
I see.
The good news is on your income taxes is everything that's applies to that house, your taxes, your insurance, maintenance items are all tax deductible because it's now become like a business for you. This house is now an income source for you.
I see.
So you get to write off expenses against that income.
That's pretty good. So if you're looking for a house, a property, let's say some anonymous person like me, if somebody was looking for a house and they want to make mortgage payments not to exceed $1,500, oh, let's be real. If we could get it down to like maybe $1,000 a month, is that possible? What kind of property are we looking at, and is it livable?
You're probably looking at maybe a condo type of property. If you have if you could afford a $600,000 mortgage at $2,500, you figure your mortgage to get $1,000 is going to put you somewhere around 150 to 200, depending if you have HOA or not. And so condominiums are available in decent neighborhoods.
So if there was a condo or a townhouse in the price range of, let's say, and they're desperate. So let's say 150,000, no more than 200,000. Is that a workable mortgage rate in there of like maybe $1,000?
It's probably closer to the $150,000 range, because you're going to want to also include you have property taxes to consider, and you'll have
what are property taxes on 150 grand?
It's 1.25% of the purchase price.
Okay.
So then you'll divide that amount by 12. So 1% would be 1,500, and then
that's doable.
So you're looking at about less than 2, right?
That's wonderful.
So it is, like I said, it's a great opportunity to buy.
It's all those investor people that are jumping in front of me. That's what I keep forgetting about. The ones that have all that cash available. No.
Well, there are certain foreclosures, like a Home Path, which is a Fannie Mae, or a Freddie Mac also has a home step program, where investors aren't allowed to make offers for 15 days. So it's geared to try and help people buy a home to live in.
Oh, that's awesome. So Fannie Mae, Freddie
Mae, Freddie Mac, who I know they get bad reps right now. They're actually out there rooting for you. Okay. And FHA, the HUD homes, are all geared first to give a homeowner an opportunity to buy a home to live in first.
Oh, that's awesome. That is totally awesome. Teresa, thank you so much for being on the show. This has been
very informative. Thank you.
Well, thank you, ladies. I appreciate it.
Kudos. We have like maybe a few minutes to wrap it up. Anybody you want to give a hello to? How about Sid?
Oh, hi, Sid.
And you're going to a party tonight.
Absolutely. It's holiday season and we're celebrating.
Yes.
Well, once again, thank you for being on From the Halls of Justice. This has been our wonderful, spectacular real estate show. I'm excited. It gives me hope. I can have the American dream.
Absolutely.
All right. And Murvet, anybody you want to give a shout out to?
No.
Okay.
My family, I guess. Hi.
We'll see you next week on From the Halls of Justice. Merry Christmas. Happy holidays. Shalom, baby.